Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hunt of Pacific Private Money, and our special guest, Ken Winans, best-selling author and financial advisor. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon, with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is entertainment. Ken, we're going to start right on with you. We've got a big show today. Got to talk about inflation, interest rates. What do people do? So go ahead, take it away.
Oh boy, what do people do? Well, don't jump off of, I shouldn't say that. Don't jump off of anything. But no, it's the world has shifted, and I've been it's funny because when I was bringing up inflation a year ago, people were saying, "Oh no, it's different this time, and everything's different." I said, "Look, you print too much money and is chasing limited goods and services. That's the classic definition of inflation, which is what I learned in school, what you guys learned in school. Yep. That's what it is. That you can't redo that definition. So we are still dealing with that. But unfortunately, when you add to the things that, the theme of the 70s, I've been talking to a lot of people about, it is just eerily similar when you think about, well, especially right now, you had political turmoil then. Well, you got political turmoil now. Yeah. You came off of a war that ended badly then, as you did now. You had this world-changing event we call COVID. Back then we called it the Arab oil embargo. We have a current war going on in the Ukraine. Well, we had wars in the Middle East going on throughout the 70s. Yeah. Social disruptions. Well, I point out to people all the time, well, back then we had the Black Panthers, we had Hugo Chavez reforms, we had gay rights, women's rights, protest marches at the schools. You had all the same stuff going on, but just different flavors of it. Yeah. But again, our country operates well when the economic machine operates well. When it doesn't, that's when all the finger pointing begins and people start taking it out on other groups. So unfortunately, the bad news is with the inflation picture, is that it is going to last for years. We're going to have this phenomenon going on for many, many years. Historically, inflation cycles run 6 to 8 years. My math says we're 2 years into this thing. Okay. And that means that for a lot of people who are used to, buy the dip in the stock market or hurry up and get back in, that's all shifted. I think, people talk about, well, what about, one of the funny things I love is when people say, but today we have technology. I said, well, that's interesting. We landed 12 guys on the moon from 1969 to 1972. And I would argue the technology that came from Apollo might actually be more transforming then than what we're now doing with technology to this day. So it's just funny how people try to find some differences. But at the end of the day, guys, when it comes to people, when it comes to their money, the machine drives by greed and fear. I don't think we've changed much from the people who are trading tulips in the Holland during the tulip mane back in the 1600s. We're just not much different.
The one thing I would add to that, though, is the fact that because technology has come where you can just take a smartphone and do trades, that's different than back then. I mean, back in the 70s, if you had, what was it, 2 million shares being traded or 3 million shares up for the entire market, that was a lot. Now you get some small stocks trading 5 million shares. Oh, sure. And so from that end of it, the technology's been a little bit.
But even technology is a constant, the speed at which it changes things. I mean, even the corrections, the way things go, they're still happening. It might be happening a little faster than it used to. Yeah. But I'm actually seriously questioning whether all this technology has really helped people all that much. I think that people are more impulsive to make decisions, where if they, in the old days, they might have called and talked to a stockbroker before they pulled the trigger. They would just have, okay, wait a minute. Whoa.
Oh, yeah. Do you think Robinhood has helped people make money or lose money at this point in the cycle since it became popular a couple of years ago?
I think the problem is, no, I agree with you, Mark. I think that to be a good investor, let's flip it around. Let's say you want to be great at real estate. You still have to study it. You still have to understand how it works. Just because you might be able to do something real estate oriented on the stock market doesn't mean you're a genius. So unfortunately, I think a lot of people, we got caught up in excess bubbles, whether it's crypto, Robinhood, the meme stocks. Whenever you get near a top in an economic cycle, this stuff percolates. And we just saw it happen again in some other ways.
It's interesting that you point out that a lot of this happens at the top of an economic cycle, as opposed to the bottom. Well, of course, at the bottom, at the Great Recession, who had money to invest? A very select few people, and they were able to profit off of that. Although many of us scraped and scratched and found a way to get back into real estate and in stocks, right? And we rode that and we did really well. But those that didn't, who were employing technology like apps like Robinhood, that made it really easy to buy stocks. And then you've got Reddit and their forums like Wall Street Bets. And then you're basically making investment decisions based on somebody's post, and then watching, your little bit of life savings, possibly disappear.
Well, and just like you said, they're electronic posts, but back in the day, I remember people had investment newsletters.
That's true.
People would subscribe to some guru. We used to call them gurus.
That's right.
And they would follow. There were a lot of different people. Oh God, what was it? It was the Granville, Joe Granville, the Granville massacre one day.
I remember that. Hey, Ken, we had to cut to a break. Yeah, I think I'm still glad my 95-year-old stockbroker uses 2 tin cans and a string. Okay, here's our first trivia question. Who played Hawkeye in the 1970 film MASH? That's our trivia question. Call 888-912-1190. First caller with correct answers going to win that tanning certificate. Stay with us. The Best of Investing will be right back. Don't touch that dial. Welcome back to the Best of Investing. I'm Edward Brown, along with Mark Hunt, Pacific Private Money, and Ken Winans, financial advisor and best-selling author. Let's see. First trivia question. Who played Hawkeye in the 1970 film MASH?
Donald Sutherland.
Very good. Donald Sutherland. That's right. Very good.
One of my favorite actors.
Yes.
He's a kick in the pants. My favorite role for him was in The Dirty Dozen. That was great.
Look at you. All right.
You know what? The one I liked was Kelly's Hero when he was.
He was great. Kelly's Hero. Yeah.
Oddball. I loved Oddball. I mean, it was just classic, No, genius guy.
All right, Ken, an email comes into the show that seems to be perfect for you. The stock market is making me nervous right now. What defensive positions should I take?
Well, a couple of things. Number one is that when you have inflation, you need to reposition your portfolio into more commodity-based plays. So, for instance, I'm buying a lot of oil and gas type companies right now. Food processing companies like Archer Daniels Midland, which is the soybean dominant company, a company called Bunge that is also in agricultural products. You need to shift your portfolio toward more commodity-based things. I would look at the commodity ETFs, where you can actually buy corn, wheat, soybeans as an ETF. Last but not least, I think it's safe to say that the bull markets that we remembered over the last 30 years, it is my opinion that party is over. The inflation situation has killed that, just as inflation killed the bull markets of the 50s and 60s.
Yeah.
The 70s took care of that. This inflation cycle is going to take care of that. So imagine a world where there is no momentum in the stock market, none. How do you make your money? In individual areas that will go up in a sideways moving market. So the point to your listener, Edward, they've got to change the way they think.
Well, that's hard to do for a lot of people.
It is.
Yeah.
No, absolutely. Well, that's really interesting. You say don't expect another bull market, because I think, you've got a whole generation, if not 2 generations, that their experience since 2010, let's say, the bottom of the recession, you got 12 years of all kinds of fun happening. You've got real estate prices going up. You got the stock market that had an amazing run. And then you've got the emergence of cryptocurrencies and Bitcoin and NFTs. And there's just been an amazing creation of wealth. And so we've seen a lot of that go down recently. So we're, the stock market index funds are down. Not the index funds, but the Dow Jones is, down to where it was in beginning of 2021. And so a lot of the gains we've maybe made in the last 18 months, we've seen them maybe get pulled back. But
I wonder if we're going to have another lost decade.
Good old fashioned investment strategies is what I hear you saying, Ken.
Absolutely.
And commodity driven investments, commodity based investments, commodity ETFs. The good news is that you just mentioned ETFs. I mean, these didn't exist the last time we were facing this kind of, whirlwind of economic conditions. And now there are platforms, so people don't have to actually figure out how to buy, pork bellies and futures and things like
Mark,
that.
you're dating yourself. We don't call it pork bellies anymore. We call them lean hogs.
Lean hogs, yeah. Well, the other thing was back in those days, the commissions were really super high on the commodities.
Yeah.
Well, that's also good.
You know what? Well, I like to talk about that when we ever, it's interesting because we are going to talk about what people are asking questions about. And one of them is, why is my money market account at my brokerage house paying me nothing? And the reason is because the brokerage houses made a deal with the investors a long time ago. We'll give you cheap commissions, but we're going to keep the spread on money between lending rates and what we give you.
Yeah.
So people are now saying, wait a minute, whoa, I want some money market on my money. Saying, hey, that's the deal you guys made.
Yeah, but how long is that going to happen? Because at some point, people are going to pull their money out.
Well, that's the well. I actually think it's going to go further than that. I think it's going to be there will be a congressional investigation. We're in an election year. Those evil Wall Street people are taking advantage of the investor. We're going to hear all this. You guys know better than I do. We're going to hear all this talk. And that is going to, because I do know for a fact that there are elected officials sending emails to industry groups saying, hey, what is going on here?
Right. Because you and I, and actually the three of us, we all remember, I mean, when I was in college, I had my money in the Franklin Money Fund making 16%. That was amazing.
Yeah.
The money market funds back then. And I know what you're saying, Edward. It's like, okay, well, are those going to come back? And what I'm hearing you say, Ken, is that's not likely to happen because the spreads just aren't there anymore. The fee income is just not there anymore.
The problem is that what Edward pointed out, I mean, the firms have to make a profit. Okay. Yes. And they decided a while ago to say, look, if we just took a spread off the money, our revenues would be more stable than commission-based revenues. So that's when Wall Street made the shift. They said, hey, we don't want to be dependent on suddenly a drop of liquidity in the market. We don't want to be dependent on that. So let's play this other game. But it will be interesting to see how they navigate this world, because Wall Street is notorious for telling people, oh, that's free. Nothing's free, guys. There's hidden fees.
Right.
Come on.
Yeah, and lately we had this money market account replacement strategy where you would put dollars into a stable coin investment that was supposed to maintain its value at $1, much like a money market account, although not guaranteed, which money market accounts weren't guaranteed 30 years ago either. And then you would stake those, a process called staking, and get returns as high as 20%. And people were going, this is the greatest thing ever. It's free money. Well, and then that ended badly just a couple of months ago with Luna going out, and so now that whole thing is kind of messed up. People are pulling their money out of those investments. So it'll be interesting to see. We can talk a little bit about in the next session. How there actually are products that have been created recently to kind of replace that strategy of where can I put my money for an above market monthly return that is collateralized with safety and security features that's not offered by my bank. And there are some
you've got the answer to that one, Mr. Hahn.
Yeah, we've got some stational funds we can talk about. That's a relatively recent investment vehicle that is becoming more prevalent. And we have one at Pacific Private Money that we could talk about.
We'll talk about that in the next segment. Before we get to break, Ken, how do people get a hold of you if they have questions about commodities and how to hedge their stock market portfolio?
Well, the best thing to do is go on our website. It's Winans, WINANS investments, plural.com. And then there they can reach out to anybody, and certainly any of the members of my staff. And then certainly just, if you enter my name, one of the benefits of being an author and a writer for Forbes, if you Google me, you'll find a way to contact me. So, but certainly I just came out with a new Forbes article, and you guys would both find that interesting. We'll talk about that after the break.
Okay, very good. We're going to cut to our second commercial trivia question here. Again, entertainment is the theme. What two Rocky III co-stars won the final match of the very first WrestleMania?
Wow.
A little bit different there. Call 888-912-1190. First caller with the correct answer wins the tanning certificate, which is, by the way, worth over $100. What two Rocky III co-stars won the final match of the very first WrestleMania? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We got a lot of good stuff to talk about when we come back. Welcome back to The Best of Investing one more time. I'm Edward Brown, your host, along with my co-host, Mark Hoff of Pacific Private Money, and our special guest who actually started the show with us way back in August of 2010, Ken Winans. All right, second trivia question. What two Rocky III co-stars won the final match of the very first WrestleMania?
I was going to say Hulk Hogan.
Hulk Hogan is one of them. Who was the other one?
Mr. T.
Yes. Very good. All right.
Yes. Oh my goodness. Wow.
Well,
right.
I'm an old guy. These are my movies. Come on.
Exactly. I know it's like I tell my kids I'm so old that basketball, it used to be a square basketball. They hadn't invented round yet. Okay, Mark, and an email comes in from a listener who I guess knows about your business, which we'll let you get into. And the question is, does rising inflation help or hurt your business, your lending business?
Right. So we have rising inflation right now. We've got real estate prices at an all-time high. You've got the media telling you that, sales are down, unit sales are down, mortgage volume is down, new construction starts are down, inflation's up, interest rates are up. Doesn't that mean it's bad news for lending and or bad news for real estate? Because maybe we're in a real estate bubble and we should be wary of where real estate prices might be heading. Well, the chairman of the Fed, our friend Mr. Powell, doesn't believe that real estate prices are going down anytime soon, nor does he believe we're in a bubble. In fact, he had a quote today that said that the supply of finished homes and the inventory of finished homes that are for sale are at an all-time low, historically low. So it's still a very tight market, he says, and prices may keep going up for a while, even in a world where rates are going up.
Now, let me ask you, do you think part of that has to do with the supply chain delay?
I don't think it's supply chain. So what the supply chain is doing is making it take longer to build homes. It's also making the cost of building homes more expensive. And so if they don't pencil out, if realtors can't, or I should say real estate development companies who build tract homes, large volumes of homes, if they can't build homes profitably, with the cost of buying land and regulations and everything, they're going to pull back. They're going to slow down. They're going to wait for things to change. So in a way, yes, the supply chain disruption has had an impact on that. Lumber prices have gone up. Cement has gone up. But really, I think what he's talking about is just overall, for the last 10 years, we just haven't added sufficient volume to the inventory of homes in the United States in general, and certainly in California in particular. And that's really driven up home prices. So we have a continued increase in our population and an increase in the number of people who are looking to buy homes, and the supply is constrained. So getting back to the question, which was really, because I'm answering, I'm talking more about just inflation, but does inflation hurt the lending business? Well, it doesn't. It's not hurting the alternative lending business, the so-called private money lending or hard money lending. Our loan volume demand is off the charts. We will do double the loan volume in 2022 than we did in 2021. And we will probably double it again next year based on what we forecast is going to be the direction of the real estate market and just overall, again, continuing demand for capital, short-term capital, ready, easy, short-term capital that real estate investors and consumers use as a tool to acquire real estate. And we become a very important tool in the last 5 years as cash buyers with the proliferation of cash buyers, winning the day when it comes to buying real estate. People can turn to companies like Pacific Private Money to make cash-like offers using our short-term bridge loans, which will allow you to make low or no contingent offers on any kind of real estate you're looking to acquire, whether it's a home to move into or investment property. And it's cash-like, no loan contingency, fast closing. You could do 10, 14, 21-day closes. And so savvy people are using that as a tool. So really what's happening in the market overall today, not just inflation, but stock market going down, and Bitcoin and other cryptocurrencies being, hammered, and then just, overall real estate being unaffordable for most people. Well, as much as I feel badly for anybody looking to buy a home today, the reality of it is there's been so much wealth created in the last 10 years, and particularly in the last 5 years, that there are more than enough people out there ready, willing, and able to buy homes today. And we just see the demand for, like I said, for our loan product continues to remain unabated. And in fact, we're still continually raising new capital, looking to our existing investors and saying, look, if you have money to invest, we would encourage you to consider increasing your investment in one of our 4 funds, and that we use our funds to make these, short-term bridge loans to people who use our money as a tool to acquire real estate, and then get long-term financing after that, or flip the property if that was their intention. So it's interesting. Real estate has been called a hedge during inflation for decades now, and that rule is not going to change. The rule of supply and demand is not going to change. The definition of inflation, as Ken pointed out earlier, that's not going to change. The economic realities, what we learned in Econ 101, I don't care what technology has brought us, it is not changing the fundamental principles of how the economy works. And so right now, for those wondering where to put their money, if you're not a stock market guy, or if you're not taking Ken's advice and looking at commodity-based stocks as a way to maybe redirect and redeploy your capital, certainly to the extent that you have an opportunity to invest in some type of real estate secured debt opportunity like we offer, or real estate itself, I think that remains a viable investment opportunity in an age of where something that we haven't experienced in maybe 20 years now, inflation's coming back.
Very good.
And, I was going to say something, Mark, something I'd add, and it's credit to you and your company. Look, everybody remembered what happened in 2007, 8, and 9. And people who are in real estate lending, I know we were talking before the show about CMOs. We're not going to repeat those mistakes.
No, it's not a credit bubble that we're going through.
We're not. It's just not.
Okay, tell you what, we're going to go to our third commercial break here. Third trivia question. What is Mark Wahlberg's famous nickname? If you remember, he became a star. He was more of a music guy, all right? 888, call 888-912-1190. First caller with the correct answer wins that tanning certificate. What is Mark Wahlberg's famous nickname? All right, stay with us. Best of Investing. We'll be right back.
Radio.
Welcome back to the Best of Investing. Edward Brown, Mark Hunt, and Ken Winans here. Okay, third trivia question. What is Mark Wahlberg's famous nickname that apparently he does not like to be called anymore?
Well, because my name is Mark, I have friends who call me Marky Mark. And so
Marky Mark, yeah. And what was the name of his group?
His rap name.
Yeah, Marky Mark and the Funky Bunch.
And the Funky Bunch.
That's right. All right. So Ken, give us some more advice.
What people should do in this turmoil today. Yeah.
At the end of the day, people still need to invest money. Mark was talking about the amount of wealth that has been, in the last 30 years. It's amazing how, in spite of everything that's happened, when you read about what's going on around the world, and people want to poo-poo this country, I'll tell you what, we have been able to stay. Imagine people in China right now. China's gotten mauled. Europe's gotten mauled. And we're doing quite well. And so the question is, what should people be doing? Well, obviously you need, just don't stick your head in the sand, look around, but there are opportunities. Certainly private real estate loans is one area that people should actually look for, but more important than that is to find somebody like Mark and Edward who know what they're doing with this stuff. Don't try to do it on your own. You'll get mauled. Same thing with corporate bonds. You can find corporate bonds that are coming due 3-4 years out. They're liquid. You can turn around and sell them if you need to. They go into a conventional brokerage account, and you're able to find paper right now that's paying 7.5% and 8%. Are they going to be AAA rated? No. But if they're 3, 4, and 5-year notes, as long as they stay in business and you diversify amongst different issuers, who doesn't, that's just go with it. It makes sense.
That's a good point, because many years ago when I used to do financial consulting, I remember looking at some Chrysler bonds that were paying 12%, and they were trading just a little below par, and but they only had like 2 years to go. And I remember telling clients, saying, listen, you know what, think about it. I mean, is Chrysler going to go out of business in 2 years? Maybe. But if they don't, the volatility of that bond is going to be practically zero, because it's got to go back up to par at some point.
Exactly.
Yeah.
Well, and remember too, though, that again, in the bond world, there is no bond exchange. And so people typically will just go and they'll look at the website of a big brokerage house and say, oh, I can build my own bond portfolio. Almost all the bonds on those websites are heavily marked up, means the yields are really low. You have to have a relationship. Again, in anything with income, you need to have a relationship with somebody you can work with who knows where to get the paper and to get it at a good price. And unfortunately for us, we actually have a portfolio that we run for clients. It's called the Winans Corporate Income Portfolio, separate managed accounts, all corporate bonds, sometimes preferred shares when they're warranted. But knock on wood, we're highly ranked by Morningstar, and that's been attracting capital. But it's about maturity. When you talk about people who've gotten mauled in bonds, like we talk about, what I would avoid right now are municipal bonds. The yields are too low. I meet people, I can't believe they're retired and they're in their 70s, and they got bonds that are coming due in 20 and 30 years out. And I tell them, why do you own a bond that's going to outlive you? That doesn't make any sense to me at all. That's crazy. But people have to be smart about it. I would say that and by the way, I really hope I'm wrong. I really do. I hope we go back to a bull market. They're fun. But the problem with a market like this is that it cannot cover up your mistakes. You've got to minimize your mistakes, and mistakes in this kind of market will be devastating to people.
Yeah, absolutely. And we teased a little bit earlier about, new types of funds that are being generated. So companies like Pacific Private Money and investment groups that are doing real estate investments or loans like we do, one of the most common ways that these companies, the industry, raises money is in the form of a private placement. A lot of people have invested in private placement. If you've invested in a mortgage pool fund, that's a private placement. If you've invested in a group that are buying real estate, buying multifamily housing, maybe buying up land, that's generally a private placement. That's that 65-page document that you probably didn't read and just signed on the last page and wrote them a check for anywhere from $50,000 to maybe several million. Well, at Pacific Private Money, we launched a fund that we learned about from our Securities Council that is a rather new idea in fund development called a gestational fund. And what that strange word really means, it's a fund designed to affect certain short-term strategies, but it remains generally liquid in design. And so, for example, our Pacific Freedom Fund is a fund that we use the money in that fund to fund and close loans that we do on a weekly basis, but then we sell those loans. We have half a dozen different buyers of our loans. Some of them are Wall Street firms, others are private firms, some are private individuals that are buying our loans, but they want to buy them when they're closed. They don't want to be on the note or deed of trust. They don't want that liability, or they're precluded by law from being on the note. So we use the Freedom Fund as a funding line, and we turn over that money 3 or 4 times a month. So it's a highly liquid fund. And so what's interesting about this fund design is that even though it's written like most private placements, where by design, it's designed to be a 1-year hold or longer. We're silent when it comes to a redemption or early redemption penalty. So we don't charge penalties for early withdrawal. So we tell people, look, if you've got money that you're sitting on from maybe a stock sale or a crypto sale or a real estate sale, or you just have money, it's not earning anything and your money market account's not following the recent increase in short-term rates. Well, we have a fund that right now is paying between 6 and 7% with monthly distributions. And the more money you invest, the higher an interest rate we can pay you. And it's designed to be liquid. You need your money in 60, 90, 120 days. Just give us 30 days notice is all we ask, and we can liquidate that for you. So it's designed to behave like a money market account, although clearly it's not a money market account. It is a private placement. And we like to hold that capital as long as we can because we make money with it. But at the end of the day, it's the closest thing you'll find today, in my opinion, with liquidity and safety and security features, because it's backed by real collateral. It's backed by the real estate loans we're making. We just happen to sell those loans. It's not a portfolio fund investment strategy. It's gestational. We're using that money to fund and close loans over and over again. So for more information, check us out. Go to our website, pacificprivatemoney.com. We got a tab on investments. That's pacificprivatemoney.com. Or you can call us anytime. We're in the 415. It's 415-883. I was going to give you my cell phone. 883-2150. 415-883-2150. Our people are standing by to answer about how you can make money with safety and security features not available in most short-term investment strategies.
Well, the best part I like is that the fact that the principal stays constant. So you don't have to look in the paper every day and say, hey, did I make or lose money? It's like a money market where you're just going to be earning an interest rate. Nice and simple. And you get your.
I was going to say, to me, it kind of reminds me a little bit of the way CDs used to be.
Yes.
A CD wasn't a note issued by a bank. It wasn't issued by the federal government. It was issued by a bank. You believed in that bank. You trusted it. You put money there, and it was money you didn't need for 30, 60, 90, 120 days. You didn't need it, so you left it alone.
But I don't know anybody who's paying over 6% though.
No,
not today's market. Not for that.
But this is, hey, Edward, but this is the point, is that if people know who to go to, whether it's Winans Investments or Pacific Private Money, there are those of us, they, excuse the pun, separate the men from the boys. It's probably bad in today's world to say that, but those of us who actually know what we're doing.
All right, audience, stay with us. Best of Investing will be back with some closing comments. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my co-host, Mark Hanf of Pacific Private Money, and our special guest, Ken Weinans of Weinings International. Or actually, is it Weinings International or is it back to Weinings Investments?
Well, we had to go back to Weinings Investments because when originally I founded it as Weinings International, but people thought we did international stocks. So I said, no.
Gotcha.
It's the DBA is Winans Investments.
Fortunately,
it's my name. So that good Dutch name, they have no trouble spelling it.
I've always kind of preferred that, to be honest with you, Ken. When I see companies with international, and I know really they're just, they're really a US based company at the end of the day, I always thought that was a little bit of a stretch to have the word international.
Thinking, do I have to fly to Dubai to go meet with them?
But but at the time I set up the company, it was hard to pick a name. It was hard to get, to set up a corporation. They were very picky, and there were some other Winans corporations that I was running into. So it is funny, though.
Interesting. I just wanted to end on a positive note and tell people that, look, this is not 2008 all over again, nor is it a run up to what happened in 2008 all over again. We're not in a credit bubble. In the United States, homeowners have 21 trillion in equity. That's 3 times what it was at the bottom of the real estate recession, which was right around 2009, 2010. And there's just, and in addition to real estate wealth, there's even notwithstanding the stock market and crypto going down, it's still a lot higher than it was just a few years ago. I mean, there's just a tremendous amount of wealth out there, and real estate is not going to crash. And I'm sorry for the people who are, the crash bros out there that are waiting for that to happen. And they've been talking about it for years, and they've been wrong for years. And they're going to continue to be wrong because of just the simple supply and demand metrics. We're just not building homes fast enough. And so, yeah, inflation is terrible. I can't stand filling up my truck at $7 a gallon now here in the Bay Area. I wish real estate wasn't as expensive as it was, but I'm also in a business that knows how to make money, in real estate, whether prices are going up or down or flat. And so there are investment strategies, as Ken pointed out. There are investment opportunities. You just need to educate yourself. And just remember the media is looking for eyeballs, and anybody with a typewriter can, or with a computer rather, who has typewriters now? Anybody with a phone can write a blog post and attract your eyeballs. And so they're going to make it look, the Drudge Report is full of headlines that will tell you how bad things are. But really, at the end of the day, there's a lot to really be, mindful of, that we're really in the recession that I think is coming is going to be more of a general recession. I don't think it's going to be a real estate recession. And, it wouldn't surprise me if it was a fairly shallow and moderate one.
I don't think it's going to be like the Great Recession.
Yeah.
In
historical perspective.
But Ken, any last comments before we cut out for our thoughts of the day?
I would say the same thing. I mean, the three of us are of an age group. We've been in the game a long time. Nothing goes straight up forever, or it certainly doesn't accelerate forever. Things pull up, they go up, they pull back. The correction in the stock market right now, I think stocks were overpriced before the correction. They're now bringing them back in line with where things should be. There will be opportunities to step in and buy. I agree that, no two recessions ever look the same. I just think that people need to be careful of who they listen to. And I like what Mark was saying, that look, you're dealing with a situation where a lot of talking heads on television. My advice is, do not listen to anybody who does not have a track record, a performance record, or some way of showing what they've done. I just no interest in listening to them. If they can't show you what they've done, don't take their advice.
Very good. All right. Thank you very much, Ken, for joining us yet again. And we're going to cut out. Here's our thoughts of the day. So a bacon, an egg, and a pancake walk into a bar, and the bartender says, "Hey, we don't serve breakfast here. And right before I die, I'm going to swallow a bag of popcorn kernels and just to make the cremation a bit more interesting." All right. Tune in next week to The Best of Investing. We'll be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. All right, guys. Perfect timing.
Nice.
Excellent.
Yeah, thanks.
All righty.
Talk to you again, Ken. I'll circle back with you in 6-8 weeks. Yeah.
When we get back, let's get together, and like I said, I'm going to be around.
We'll get some seminars together.
Yeah,
absolutely. Yeah, that's the other thing I want to talk to you. Let's look at the fall when everybody's back and summer's over and all that. It'd be a great time to do it.
Absolutely, and I want to circle back with you and see what weekend we might take the wet bikes out.
Let's do it, man. Sea-Doos. I know self-respecting guy right a wet bike. You're dating yourself, Mark. All right, guys, I gotta go. I'll talk to you all
later.
later.
Bye, guys. See you later.
Bye, guys.